Good afternoon and welcome to this week's grain market update with ADM. My name is Cameron Curry. I'm the newly appointed head of feed wheat for ADM Agriculture. Thank you for joining me today. The last week, we've seen grain markets very much continue their recent downward trajectory, with the main driver to this being the extension of the Black Sea grain corridor until at least the 18th of July. The agreement, which was first brokered in July of 2022, is viewed by the market as a fundamental stepping stone to the world accessing Ukrainian grain. And up until last Wednesday's announcement, it was looking increasingly unlikely the deal would be extended further. As such, markets gradually priced in an element of risk premium, supporting prices in the run-up to the announcement. The unexpected U-turn and subsequent extension sent markets into freefall at the end of last week, the sentiment once again returning to unrestricted global grain supply for another 2 months. Russia and Ukraine have both been very aggressive sellers recently, offering cargoes of cheap grain, but news reports that Russia was attempting to block Ukrainian vessels on Tuesday this week was enough to spook markets, and this sentiment caused a short-term lift in prices as a result. Clearly, the market is now expecting a smooth continuation of the grain corridor, but any real deviation from this will be viewed as a bullish signal and could cause upward market reaction with the balance so delicately struck. Meanwhile, market remains anchored by big corn crops globally. Conditions in Brazil are hot and dry for the impending Safrinha corn harvest, which is projected to be a record, up towards 100 million tonnes, adding huge weight to a total corn production figure of 129 million tonnes. If realised, then combined with Argentina's 54 million tonne corn crop, the global marketplace could well have access to around 95 million tonnes of South American corn exports, which is currently undercutting most other origins, both for wheat and corn, around the world. This is around 17 million tonnes more than last year, and as a result, wheat prices have had to discount themselves aggressively to compete for demand in the face of this. Add into this a corn crop in the USA, which is currently 81% planted and going into favourable conditions, with 52% of that crop already emerged. Both figures are well above the 5-year average and once again add weight to the corn prices globally. The dry conditions and dry forecast for much of the US corn belt for the next fortnight may well become a flag for germination, but at this stage, it's yet to be seen as any real bullish price driver. From a UK perspective, the market is still expecting a large carry-out from this year's wheat crop, with fresh export business stagnating over the last few weeks. Late season domestic demand is sporadic, and against plentiful supplies of farm grain isn't enough to support markets with any real significance. The UK weather forecast is extremely favourable for developing crops, with an area of high pressure lingering over most of Western Europe for the next 2 weeks, bringing with it dry, warm conditions and plenty of sunlight, which should more than make up for the wet and gloomy conditions that we saw in March and April. Most trade estimates for the UK wheat production fall within the 15.7 to 16.2 million tonne range, which if realised would give the UK a huge exportable surplus for 2023 crop. Despite this, we're seeing domestic wheat prices appreciate versus competing origins on an export basis, which means that the market has a lot of work to do on the downside in order for the surplus to shift and to prevent a real oversupply issue developing for the next 12 months. From a technical perspective, we remain in the middle of support and resistance on London November 23 wheat futures. We see underlying support at £183 a tonne, coming from the long-term pre-Ukraine invasion shelf level, and overhead resistance at £192 and £205 respectively, which were support levels in this long-term downtrend before they were broken through. Stochastics are chopping around oversold, but are yet to break positively, with parabolic still pointing lower. But we need to see a real break of £183 a tonne on November futures to continue this short-term, more aggressive downtrend, having touched £183 and 5 pence only yesterday. Hopefully that's been a useful update for you. As always, if you've got any comments or questions, please get in touch with us. We're always keen to hear feedback, and hopefully this market update has given you some food for thought for your trading going forward. Thanks very much for joining me. Goodbye.